This is an update to my global winners portfolio, which looks across 5 different groups of exchange traded funds to find the best performers. This month, we find that 3 of the 5 categories made it into the portfolio, and we've got a change at the country level. But more generally, these momentum strategies are a great way to keep track of what's going on in markets, but also to think about the drivers behind those changes. And if you want to keep track of what I've done to the portfolio, you can do that on stockcar.io, which is actually sponsoring this video. So let's look at my global winners portfolio in a bit more detail. I think what characterizes 2022 is a growing expectation of a recession in the United States and elsewhere. And in fact, the graph you can see beneath me is a model published by the Fed, which looks 12 months ahead at that probability of recession. And currently it's flagging a probability of more than 70%. And I think that chimes very well with the expectation of many market participants. Even though we can't see the hard data for it yet, GDP is a lagging indicator, many people think that we could be entering a recession towards the end of this year. Now, a US recession affects many different asset classes. For example, the price of oil usually falls when there's a US recession, and that's because there's less demand for oil and that pushes down its price. The US is a big consumer of oil, as well as now being a producer of oil. That in turn will affect the prices of many funds which have exposure to oil, but also direct commodity funds which have oil exposure. Now, long-term government bonds have yields which are driven very much by growth expectations. And if growth expectations fall, then so do bond yields. But there's an inverse relationship between bond yields and bond prices, so we'd expect bond prices to rally at the long end of the curve. Now, if yields are falling, one group of equities which actually like that environment of low interest rates are growth stocks. So what we might also expect is that growth stocks would rally as yields fall and as growth expectations fall. Now, a big driver of inflation in the United States has been energy prices. And if you look at the energy components of CPI, they're still at very high levels. However, if we look at more frequently updated data, such as weekly gasoline prices or the price of crude oil, which updates daily, we have seen those peak. For example, gasoline peaked in mid-June of this year, and if we look at crude oil, that peaked in March of this year. Now, that in turn has had an effect on many different asset classes, and we'll see it in the presentation which is to follow. Some of the effects are very obvious, where if you look at funds which have direct energy exposure, like DBE, which is the PowerShares DB Energy Fund, or USO, which is a US oil fund, or XLE, which is the energy sector, all of those started to fall just before gasoline peaked in June of this year. They also fell fairly sharply when oil peaked in March of this year. But what's really interesting is that as growth expectations have reversed, people now expect a recession, the value of TLT, which is long duration US Treasuries, has also turned the corner after a huge sell-off since the beginning of the year. We've also seen tech stocks, which also got pummeled by higher interest rates. We've also seen those start to rally, as have growth funds like IVW. So certainly since the summer, what we've seen is a rally in many of these funds. However, our model uses a 180-day look-back period, so these changes haven't shown up yet in our look-back period, which means that we're kind of behind the curve with our portfolio. So it's going to be a rough ride until the momentum does show up over that time period. Let's just recap how the strategy works, and we can start with the funds that we choose from. The strategy looks at momentum across 5 different groups of funds. The first group is countries. We have 44 potential choices. We have 18 factors. Think of these as approaches to investing which have a certain style, such as value and growth. We have 11 US sectors. These are industries which a stock belongs to. We have 8 commodity funds. And finally, we have 9 different types of bond in 9 bond funds. To select the best fund in each category, we use something called momentum. What that means is that we look back over the previous 180 days to find the return of each fund, and the one with the biggest return is the one that makes it through to the portfolio. If none of the funds within the category have got a positive return, then that's not included in this month's allocation. If we look at the historic return and risk of this strategy, and here you can see the return of the strategy since 2004, That's the red line on the graph versus the S&P, which is the blue line. And you can see over that period of time, it has outperformed the S&P 500. In this top panel, you can see the drawdown of the strategy. That's how much it's fallen since its previous all-time high. And its worst period was in 2009, when it would have fallen by about 30% versus the S&P, which fell by over 50%. There was also a drawdown in 2020 with the pandemic, which was roughly the same size, slightly larger than the one for the S&P. And in the recent drawdown, there hasn't been such a big drawdown, although this month you can see that the reversal in momentum I was talking about has actually made the strategy fall quite sharply. However, the fall isn't as big as it has been for the S&P 500. Now we can look at how well it's performed over the last month. Now, the three funds that the strategy chose last month were IDO, which is the iShares MSCI Indonesia tracker. That's actually fallen by 4.5% versus a slight rise in the S&P of about 3%. So that has underperformed. But the really big underperformance is in the energy fund from PowerShares, which is down about 17% over the last month, and the fall in the Energy Select Spider Fund. So that's down by over 18% over the month. And again, that's due to this reversal in energy prices, which we've seen recently. Another thing we can do is pretend that we had perfect foresight and we knew at the beginning of last month exactly which funds would have performed best. If that was the case, then IPO, which is the Renaissance IPO ETF, is the best performer. That's got a very big tilt towards growth stocks, and it's composed of stocks which have recently been listed on the stock exchange. Amongst the sectors, a defensive sector performed best, so that's the XLV Healthcare ETF. And as we saw, long duration yields have been falling, which means that long duration bond prices have been rising. So TLT, the very long duration US Treasury fund, has actually been the best performer amongst the bond funds. Amongst countries, Israel is the best performer, that's up by over 4%. And none of the commodity funds have done well over the previous month. They've all fallen, and cane, which is the sugar ETF, that fell by the least, which is minus 1%. This is what stockcard.io actually looks like, and if you want to find my portfolio, just type Ramin into this search box at the top, and here's my Ramin's Global Winners portfolio. So here you can see the latest changes over the previous month. And you can see I sold my iShares MSCI Indonesia ETF because its momentum fell below the top spot. And in its place, I've chosen the iShares MSCI UAE ETF. That's the United Arab Emirates. Now, if you want to follow this portfolio, just click on this follow bell in the top right-hand part of the screen, and then you'll be notified of any changes as I make them. Now, StockCard's free to use if you want to just track my portfolio, but if you do want all of the whistles and bells and the full functionality, then you'd go for the VIP subscription. Now, if you do that and you want a 10% discount from your membership, then just use the promo code PensionCraft. That's the name of our channel with no spaces. Now let's look at our country choice for this month. Over the last 180 days, the best momentum has been with the UAE fund. That's the United Arab Emirates, which we saw previously on StockCard. And in fact, it's the only country which has a positive momentum over that 180-day period. And if we look at the time series over that 180-day period, you can see that UAE, while its momentum is positive, it's still above the zero line here. It's not that far above Qatar and ECH, which is Chile. The first two are very much exposed to energy, and the third one to industrial metals and silver. Now, one of the cool things on StockCard is that you can drill into a particular fund to learn more about it. So let's click on this UAE ETF. So for example, you can see that this fund has returned about the same as the market, or that the risk of the fund is reasonable. So for example, you could drill into one of these categories and see exactly what that means. So you can see the maximum drawdown over the previous year. That's the maximum peak to trough fall. You can see the turnover ratio, so how much of the stock is being churned all the time. And in the case of a passive fund, what's interesting is how much it deviates from the category. So if we look at the returns over the previous year, you can see that it has come down from its peak, which was in April of this year. But while the momentum since then has largely been negative, it's turned positive recently. So it certainly has stabilized. If we look at the UAE's exposure, you can see that it's quite high dividend paying, and it also has a big exposure to communication services, also financial services. There are 36 stocks held by the ETF, and if you want to learn more about the index which it's tracking, you can just search here for MSCI All UAE Capped NRUSD, and that'll turn up a PDF from MSCI, so you can drill into exactly the details of its index. You can also look at its holdings. For example, here are the top 25, and in fact, just the top 2 make up over 40% of the fund's holdings. And that's first Abu Dhabi Bank, so that's a financial, and the second biggest holding, which makes up about a fifth of the fund, is the Emirates Telecommunications Group. Now, even though neither of those is an explicit energy fund, if you plot the returns of this fund versus oil, they track one another very closely. So this is directly an energy play, even though it may not seem like it when you look at the holdings. Now let's look at the choice of factor. Well, in the last 180 days, none of the factor returns were positive, so none of these funds make it through to the portfolio. But what you can see is that over this period, the value style of investing, and high dividend yield is just another take on value, has performed best. And the worst performers are growth style of investing funds. Remember that IPO, which contains newly listed stocks, also has that tilt towards growth, as does Guru Holdings, which looks at hedge fund favorites. But the Russell 2000 growth, the Russell 1000 growth, both of those come near the bottom of the list. So the value of all of these funds is below 100, which meant they fell over this 180-day period. And you can see that high dividend yield, which is VYM, has actually held up pretty well. It's only fallen by 5% over that period. Minimum volatility, which is also a very safe fund, has also not fallen by much, only 7%. But still, for this month, no factor funds. If we look at sectors, the sector that's best is actually the same one as last month, which is energy. So that's XLE. You can see that its return is far above any of the other sectors. And looking at the time series, you can see that XLE has certainly turned around when energy prices fell, as we saw at the beginning. But certainly over this 180-day period, it's still by far the best performing sector. So that'll be our sector choice for this month. If we look at commodities, again, energy comes top of the pack. So DBE, the PowerShares DB Energy Fund, is our choice for this month. And as with XLE, you can see that it peaked roughly the same time as oil prices in June of this year. And it has fallen since then, but still over a 180-day period, it's the best performer. So that's our choice for this month. And finally, we'll look at bonds. And here, again, we find that there's nothing which has a momentum that's positive. So we're not going to choose any bond funds for this month. Generally, the largest falls have been in emerging markets, but also for convertible bonds because of their equity exposure. And certainly over this 180-day period, TLT is down by a huge 21%. The fund which has the smallest fall is SHY, which has the shortest duration treasuries in it. That just buys 1 to 3 year US treasuries. Now, there has been a turnaround in treasuries, particularly TLT, over the last month or so, as we saw, but not over this look-back period. So certainly for this month, no bonds. In summary then, 2 of our categories didn't add anything to the portfolio, and that's for the second month running. That's factors, where everything was negative, and bonds, where returns were again all negative. However, 3 of the funds which we did choose were all due to energy doing very well over the last 180 days. So that's UAE for the country choice, XLE, the Energy Select Spider Fund, and DBE, which is our commodity choice. So there we have it, another energy-dominated choice of 3 funds for July. Now, don't forget our offer with stockcar.io. You can find more details about that in the description beneath me. But if you use the promo code PensionCraft, no spaces, then you'll get 10% off your first VIP subscription. And, as always, thank you for listening.